Hi guys, it's Sam and welcome back to the UK Mortgage Centre channel, or if you're new here, hello. Now in this video, I'm going to be breaking down how you can work out your mortgage affordability. And now that I've got your attention, why don't you subscribe? It's free and that way you're not going to miss an upload. Okay, so how to calculate that all-important mortgage affordability. So to calculate the affordability, let's assume you're applying with a partner. You earn 25 grand a year, they earn 35 grand a year. The joint annual income is £60,000. Let's assume you have little to no credit commitments and you're also still living at home. As a general rule of thumb, most lenders will offer around 4.5 times your annual income. So if we times the 60 grand by 4.5, you're going to get £270,000. So that's roughly what you can afford as a mortgage. On the higher, then your deposit amount will be able to sit on top of that, which means if you look at the property worth £300,000, you'd need a 10% deposit, so 30 grand, and that way your mortgage loan would sit to be £270,000. If you saw a property worth 310,000, then you need to put down a 40 grand deposit and your loan would still be 270 grand. Simple. However, you will need to factor in any current commitments that you have. So if you have a car loan at £400 a month, that's nearly 5 grand a year. So if you need to take this off your total estimated loan as well. Now, disclaimer, this is just a rough calculation and every lender will have their own affordability calculator. So don't take this as gospel. Moving on to how a lender will assess your affordability, they typically look at things like this. So number one, your gross annual income, not the amount that's paid direct to your bank account. That's what's called your net pay. That's after you've paid things like income tax, national insurance, and pension contributions. We're talking about the top line figure. The second thing a lender will use to calculate the affordability is outgoings, usually committed expenditure. This is going to include things like loans, overdrafts, car payments, credit cards, Klarna, all that sort of stuff. And a lender will usually factor in ONS data of someone buying a property and will use the average of like the gas and electricity, council tax, leasehold and service charges for a property that's going to be leasehold. Once a lender knows the income and expenditure, they can work out their magic to see how much you can afford officially. Other factors that can impact affordability are the length of the mortgage term. Longer the mortgage term, you might be able to borrow a little bit more. The length of the product, like a 2-year fixed or a 5-year fixed. And again, you might be able to borrow a little bit more in a 5-year fixed, and your loan to value. So the bigger the deposit, it reduces the lender's risk and therefore occasionally can improve the overall mortgage affordability. So there's plenty to consider. We do have a mortgage affordability calculator on our website, so we'll leave that in the description box below, as we'll link this to our first time buyer brochure as well, which is full of handy tips and tricks and info on buying your first home. But if you did like today's video, please give it a thumbs up, and if you have any questions, drop them in the comments below or drop our team a quick call on 01925 573 328.